The Bank of Canada has held the interest rate steady at 2.75%. Let's bring in David McDonald, senior economist with the Canadian Centre for Policy Alternatives, with more. David, good morning to you. So economists were divided whether or not there would be another cut or whether the Bank of Canada would hold pat. Was this in line with what you expected?
I thought there might have been a cut, but yeah, it was about 50-50 in terms of what was going to happen today. I mean, the bank has updated their longer-term projections, and they've done something quite unusual, actually. They have two scenarios of what's going to play out. This was certainly on the mind of the governor a couple of weeks ago in a speech. He just said, look, how do you predict the future when you have no idea in the chaos of a trade war? And so now there's two scenarios. The first scenario is the blowover scenario, that all of this is bluster. But nonetheless, we don't see a protracted trade war. We don't see a recession, and inflation stays roughly on target. And the second scenario is the stagflation scenario, where we end up in a recession next year and we see prices rise to the 3% mark. And so, I mean, this is kind of, we're not sure which one of them it's going to be, and maybe that led into the decision today to do nothing at this point and wait and see which one of these starts to pan out over the coming months.
So what are you listening for then from Tiff Macklin when he explains the bank's decision?
Well, I'd expect that this will be similar to the message that he's been giving over the last little while, which is that it's extremely difficult to know what was going to happen about a year from now or a year and a half from now. That's what the Bank of Canada is targeting. I mean, when they make changes to the interest rate, it takes that long for those changes to bake themselves into the economy and impact GDP growth as well as the inflation rate. At this point, I think, you know, just like he did a couple weeks ago, he's going to throw up his arms and say, we don't know what's going to happen a year from now. We've got these two scenarios. We plugged them into our, input-output model, and they showed two very different results. So at this point, we're going to wait and see. Do we end up in the blowover scenario where we just keep our heads down and we don't see a massive trade war with the U.S., or is this just something that continues? We end up in a recession, we end up with a trade battle with the U.S., prices start to rise, and we end up with the dreaded stagflation scenario. In the Bank of Canada's mind, these are both equally probable at this point.
What does today's decision to hold things steady mean for consumers, David?
Well, it certainly means that if you're renewing a mortgage, if you're trying to get a car loan or something like that, that's not going to become cheaper. If you've got a variable rate mortgage, it's not going to become cheaper. The story of the inflation figures that came out yesterday, they were certainly down a little bit from the previous month. But the inflation over 2% continues to be a story about housing. It continues to be higher than normal mortgage interest costs, as well as higher than normal rents. And these will continue as long as interest rates continue to stay at the higher end of the range.